Hello, everyone. This is Dr. Duru from Ahan Analytics with the market breadth. All right. Well, just as I made the case last week, it seems the market is indeed all set to end this year, 2025, on a positive note. So I thought I'd spend just a few minutes in this video talking about what I'm looking out for in 2026. I already did a previous post and video on how to get ready for next year, and I agree with Tom Lee that some sort of significant pullback, we're overdue, some sort of significant pullback will likely unfold sometime in the first half of the year. Don't know when, don't know how, but I just want to be prepared for that. Now, despite that, or maybe because of that, I have a list of themes and narratives that I am going to be ready to buy. Maybe I buy them ahead of any kind of pullback because there's always that, uncertainty, and I don't want to just wait stubbornly until a pullback that never comes. So anyway, what are those themes? Well, it seems like the US is going to try to run the economy very hot in 2026, meaning lower rates and lots of fiscal stimulus and lots of investment. And so what happens when the economy runs hot? Well, consumables get consumed. So I am thinking high production, high consumption, and high investment all leads to commodities. It doesn't have to all lead to it, but in terms of investing theme, I'm looking at commodities as a big place I want to be in. I already have a good amount, but I really want to pour on the fuel, so to speak, onto the commodity plays. And related to that, I'm still a big bull on rare earth and related stock plays. We had a big period where that was all the rage, and now suddenly nobody talks about investing in rare earth. That's the moment I really like. And you'll see in the charts what the result has been because nobody's been talking about rare earths for a little bit of time now. Then I'm also looking at biotech. Now, biotech has had an incredible run up for the last several months. And I have had some very good trades in some individual biotech stocks. And I still have a few that I'm holding on to, and I'll talk about them in the video. And then finally, there's some other kind of one-off type plays. So for instance, in semiconductors, I'm looking at Intel as a very interesting possibility to finally buy back into. I already have enough AI-related plays, so I do not think of 2026 as a year where the AI theme is going to be all that important for me. I'm just hoping, I can hold on to the remaining ones that I have after I had to do some trimming earlier. And again, there was a video and a post about that. And then finally, another important one-off is IPO. That's an ETF, the Renaissance IPO ETF. I think next year could be big for IPOs. A lot of them will probably be AI related. I'm not looking at IPO specifically because it's going to be an AI play, but I just think in an economy that's running hot, IPOs also should be very hot. I don't want to bet on any particular one, and I think of IPO as a way to go. All right, let's go ahead and take a look at these charts. All right, well, as always, let's start with the general charts and the indices. This is market breadth, what I like to call AT50 for above the 50. It's the percent of stocks trading above their 50-day moving average. I know I sound like a broken record. The primary downtrend is still in place, so I remain wary on the market overall, and I think this downtrend can easily set us up for the pullback that I expect in the first half of 2026. But given the way that market breadth AT50 has been hugging this primary downtrend, I just can't imagine I can't imagine AT50 avoiding a breakout. I say a different way. I have to expect a breakout that's sustained above this downtrend line. We're just hugging this for far too long. And if that breakout happens, then we run up to the overbought level. Again, I think this is overdue. 70% is the overbought level here. And then maybe that would set up a more credible topping in the market that then leads into the 15% pullback. Again, these are not predictions, so to speak, they're just scenarios that I'm preparing for. So think of all of this information that I'm giving to you for educational purposes. Please invest and trade with your own time horizons and risk preferences in mind. If you have any comments or questions, put them down below. If there's a particular individual stock you want to fast forward to, the summarized timeline is down below in the caption area. And as always, please like and share this content so the algorithm knows what's up, and you can subscribe if you want more content like this. All right, let's jump into the indices. S&P 500, let's go to logarithmic scale. So for the S&P 500, you can see we made an all-time high. This was a holiday shortened week with Christmas, and we're at the all-time high. So finally, the double top set up by the Fed rate cut has been invalidated, and this provides a runway for higher and higher prices for the S&P 500. This is kind of why I really suspect we're finally going to break through that downtrend on market breadth in the short on AT50 in the short term, and then eventually get to that overbought threshold. So that is my overall expectation. And then the NASDAQ still has room to go to get to its all-time high. I mean, sure, it's not that much more, but you can see here that this week's holiday shortened rally got the NASDAQ back to the prior peak, and it's not too far-fetched to think that and there will be enough buyers to nudge this up and break out to a new all-time high, which is around 23,963. Oh, and I forgot to mention, let's go back to AT50. AT50 at 58.6% is doing pretty good. If we're above 50%, that means the majority of stocks are above the 50-day moving average, which is overall healthy, even though there's a downtrend in place. And let me quickly go to AT200, which is the percentage stocks trading above the 200-day moving average. This indicator of longer-term market health remains above the prior primary trend. So this is supportive as well for an eventual breakout of the short-term market breadth. So sorry, I had to go back really quickly on the market breadth review. All right, now let's go to the ETF of small caps, IWM, which is the iShares Russell 2000 ETF. And, just like the S&P 500 and the NASDAQ, overall, it was a kind of a churning week, even though the S&P 500 pulled off an all-time high. IWM, same thing. At least it's above its 20-day moving average, which is this dotted line or dashed line. It also has room for a rally, given it's still off the all-time high that was set earlier this month. And with the pullback to the 20-day moving average, of course, I bought some call options as a trade around my core central position in IWM shares. Okay, let's dive into those individual stocks. First of all, Rio Tinto, like I said, commodities, big theme for next year. The commodity run has already started. Rio Tinto is one of my best commodity plays. You can see here it broke out essentially at the beginning of the month of December at 72.68, and it's traded up another 10 points. So that's about a 15% gain for the month to date, and I think there's more to come just in December alone. And again, like I said, the reason why I'm really bullish on commodities is that the U.S. economy is likely to run hot next year, and this is a place to be in that scenario. We also have copper. So, I forgot to mention Rio Tinto, ticker symbol RIO. Its main thing is iron ore, but it also has other commodities. Freeport-McMoRan, ticker symbol FCX, is copper. And copper, I want to pull back here. You can see that it has basically been trading nowhere for now almost 6 years. 5 years. So I think copper is well overdue for a sustained breakout. So this is why I really like this play. I was fortunate enough, again, when I was talking about commodities, I was talking about them earlier in November. So I jumped into FCX back here. So this is one of my other good commodity plays. Now, let me talk about Cleveland-Cliffs, ticker symbol CLF. They're a steel company. And earlier they caused some excitement because they wanted to get into rare earths. And the stock did jump at first on earnings, 21.5% gain back in, October. But then there was a downgrade and an $11 price target, so it immediately dropped. Stock had really continued to collapse. And then the company, I guess the person who downgraded Cleveland-Cliffs kind of suspected the company would need to sell shares to finance its operations. That dropped the stock another 13%, and the selling just didn't stop until, boom, 200-day moving average support held. That's the blue line there. Gotta love those technicals. And it was here that I said, oh, let me go ahead and get into some Cleveland Cliffs because it looks like that support is holding. Sure enough, it has held ever since. And now we have this bullish 50-day moving average breakout. And now it looks like it's going to get right back and reverse all of these losses because it's right back to around. Actually, it's more than around. Let me zoom in here. You can see here, Cleveland Cliffs was at $13.31 before earnings, and now it's almost at 14. So it's starting to refill that post earnings gap up. So that's bullish. So I think this Cleveland Cliffs will be a great combination between rare earths and commodities or commodity-like materials. And a good way, basically, to play both sides. Now, if I pull back here, you can see Cleveland Cliffs has also had a problem in that it's well off its all-time high. I think that was set in 2022. Let's actually take a quick look here. Actually, no, sorry. Its all-time high was way back in 2008. So it is well off of those levels. So it's kind of been a beaten-up stock for years, secular loser, but it is good for plays for very cyclical reasons. And I think this is an upcycle for Cleveland Cliffs. I mean, you could see earlier in June or late May, it got down to as low as $6. So it's doing pretty good just to be where it is here now. I talked about rare earths. There's a lot of them that I could show, but one of my favorites is Ucore Rare Metals. They're a Canadian company, and they have deposits in Alaska. I think that's the major one. And in its peak, at the peak hype of rare earths in October, got up to 1075. That was an all-time high. And the stock quickly was cut more than in half. And so I've been taking advantage of these quote unquote discounts, even though it has struggled to trade above the 50-day moving average, which is that red line. It's basically consolidating from my standpoint. If it can get right back down, I guess this is another cut in half again, back to the 200-day moving average. Oh, I will really load up at that point. I think Ucore is a very solid long-term rare earths play, particularly because they're doing processing of rare earth deposits. All right. Now, I talked about biotech. This has been a fascinating one. IBB, iShares Biotechnology ETF. I mean, it's been almost a straight run up since the lows of the year. IBB sold off, even though it's not really directly impacted by tariffs. It's sold off with the tariff drama, trauma, and noise back in April, and it has just been on a tear ever since. And along the way, I have been buying individual stocks without seeing the overall uptrend. I only noticed that a few months ago. I said, wait a sec, the entire sector is going up. So that gave me more context as to why one after another, the biotech plays that I was trading were doing well. And one of the best ones that I still have is Syndax, Pharmaceuticals, ticker symbol SNDX. It caught my attention because the CFO and the chief medical officer loaded up on shares way back in May. And after a 21% post-earnings gain in August, it has been doing pretty well ever since and has given me even some dips to add to the position. So this is one of my favorite ones. And this is also a theme I'm going to be looking at next year, which is insider buying. Insider buying in 2025 was such a great winning strategy. I think there was only one stock that I'm still holding where the insider buying has not yet paid out. I'm still holding that position, but overall, it was a big winner this year, just following on the footsteps of the executive insiders like the CFOs, the CEOs, and so on. When they have confidence enough to put some significant capital into a stock, I want to be there. All right. I also talked about Intel as a one-off. And the reason why I say a one-off, even though the semiconductor industry in general has been doing very well, I call it a one-off because I think of Intel as a very special case. It's one of the few semiconductor plays that's in recovery mode, well off its all-time high. You could put a pause in the video and review all of these news-driven events. I think Intel still has strong news-related tailwinds. And so, but I haven't gotten back in because the technicals haven't supported. I missed the buy when it broke out above the 50-day moving average here. And I kept waiting for Intel to retest the 50-day moving average, but then it slid right underneath. And so I'm just on hold, waiting for a fresh chance to buy above the 50-day moving average. If we get too close to earnings, I probably will just hold again and then hope that the stock doesn't run away from me. But Intel Corporation, ticker symbol INTC, is at the top of my shopping list in terms of semiconductors. Like I said, I know semiconductors have had a very good year this year. Intel actually, because of the latest news-driven tailwinds, has actually ended up having a very good 2025 after having a very horrible 2024. And you can see it's still not recovered its losses from 2024. Anyway, AI has been a big story driving up semiconductor stocks. Now Intel has jumped into the game. I'm not buying it necessarily for the AI related play. It's more just a recovery play. And along those lines of big cap tech that's in recovery mode, I forgot to mention this in the intro, I'm also looking at beaten up software companies. And I think the big theme for 2025 has been, oh no, AI is going to wipe out every single major software, or going to wipe out all the software companies. I don't think so. And some of these software companies are actually using AI in their businesses and supposedly, reportedly doing quite well by it. Ticker symbol CRM, Salesforce, is top of my list of beaten up software stocks. I know the valuation's still high. It is down significantly for the year. So just on that level alone, it's interesting. You could see it's had a very choppy experience. I mean, where it's trading now, it saw these levels way back in 2021. It's not, it did bust after that, and it's still well off its lows from the bear market. But I think this is a great opportunity. The stock has now broken out and held 200-day moving average support. So it's actually technically in bullish territory. I should be buying it here. I'm trying to wait until January. I really want to, see more. I basically want to see whether January is going to hold up and not be the exact month when that big pullback happens. But then another beaten up stock that's really taken a bad rap is Adobe, ticker symbol ADBE. It is not yet in bullish position. It's still under the 200-day moving average resistance, which has really defined the bearishness in Adobe ever since early 2024. And you can see Adobe is well off its highs from 2021. It has really been a beaten up stock. I think it's almost 50% below those levels. I just think that Adobe is making the right moves in terms of AI. Yes, maybe some of its products are getting a bad rap, but it is going to turn around the ship. That is my premise. That's my narrative. And that's what I'm looking for. I just need to see the technicals sort of validate or at least align with my bullish opinion. Again, you can, if you have any questions on Adobe, you can always put them down below. All right, so these are like the top two beaten up software stocks on my list, but I am keeping an eye on any and all beaten up software stocks, especially if I see that the narrative is AI might wipe out their long-standing business. Now, along the lines sort of AI is IPO, Renaissance IPO ETF, ticker symbol IPO. And again, like I said in the intro, I already have a holding in IPO, actually. I'm not looking to buy more because of the AI related play. I just think that in an economy that's running hot, IPOs will run hot, and IPO, the ETF, should also do very well in that environment. If it's because of AI related stocks, so be it. But that's not the specific direct reason why I want to buy it. IPO did have a bearish scare in November, broke down and confirmed a 200-day moving average breakdown. You can see that here. But fortunately, in December, it's recovered. It's holding above the 200-day moving average, and now it's pivoting around its 50-day moving average. The red line, I think, is back in, relatively good bullish position. But I do want to be on alert to buy more when the technicals tell me to do so. All right, we're almost to the end. The last one, I didn't mention this in the intro either, which is ITB, home builders. I think, home builders for me is always a big theme. Right now, we're in the middle of the relative seasonal strength for home builders that has not been working out like it typically does. So I am on alert. You can even see here in the seasonals. This is tradingview.com. You can see the seasonals this year, which is that blue line. ITB has really been well off the expectations. Even with last year's poor seasonal trade, Was that last year? Green is 2024. This year is even worse for ITB. 2023 was a banner year for the trade. Anyway, all that to say is, look, if the economy is going to run hot, home builders eventually are going to benefit, especially if rates are being held down low enough for mortgage rates to come down. The only wild card is whether the long-term bond market will play ball or play along and not let long-term rates get out of hand because they're afraid of inflation. Now, granted, that is the big wild card in terms on the negative side for me, which is an economy running hot, also risk inflation running higher. Right now, we're still in this era of sticky inflation. That's why the Fed has been really slow and cautious as a group with its interest rate cuts. But I think they're going to be forced to respond to a weakening job market. They're going to be forced to respond to political pressures, and they're going to be one of many elements trying to push the economy to run hot next year. And in that scenario, I think home builders will benefit, but clearly it's going to take some more time than I thought. I was hoping that this rebound here from November would be the start of a very strong seasonal period. It hasn't worked out. And in fact, ITB, which is the ticker symbol for iShares US Home Construction ETF, is actually back in a bear market. It's one of those few places where a bear market is still in full effect. I mean, in aggregate. And here's the 20% line, the line that represents 20% off of ITB's all-time high. And you can see it toyed around with this line a lot in the past several months, but now it's been spending more time in the bear market than above it ever since October's breakdown. So this is not encouraging for the short term. I'm looking ahead and seeing the positive case. All right, that's it. Thanks for checking me out. Like I said earlier, if you have any questions, put them down below. Feedback's always welcome. Please subscribe to the channel and like and share the content so that the algorithm knows what's up. Until the next time, I will see you next week. Actually, hopefully you have a good holidays, and I guess next week will be the new year. Take care. Thanks a lot, everyone. Bye.